Today, I wanted to take a look at WebStreet and talk about how it works, the economics of website investing, the risks, and of course, give my take on the WebStreet platform. Now, for those of you guys out there not familiar with myself and the channel here, I've been in the online business space since 2009, having both started, acquired, and also sold online businesses. And WebStreet is something that has been on my radar as an investment vehicle. So if you're considering investing with WebStreet or you're just interested in acquiring and operating online businesses, you'll probably find this video helpful and insightful. And if you do, you know the drill. Be sure to smash that like button to help me out in the YouTube algorithm and hit that subscribe button so you get all of my insight into online businesses. Now let's jump into it with how WebStreet works. WebStreet is a platform that lets you invest in online business acquisitions passively. We need to stress the passively part. Because with WebStreet, you invest your cash into an online business acquisition along with other investors in the fund that someone else is going to operate. So this is not something where you find a business to buy that you're going to operate yourself. Instead, this is simply where you invest your cash into online business acquisitions that someone else is going to operate. And this is really good if you already own online businesses, right? And you just don't have the time to acquire all of the online businesses that you want, or maybe you don't have that cash, or maybe you just want some diversification. You want to invest a little bit into a bunch of different online businesses, or maybe even you're not in the online business space at all. You're just looking for online businesses as a separate asset class. That is where this really works out. But again, this is passive. Somebody else is going to be running the business. So when you join WebStreet, and I have not done that yet, I do plan to, you are presented with the available investments. And here we can see some examples, and I don't know how realistic they are. I mean, I think the numbers are fairly realistic, but I just don't know if these are actual real investment deals or just made up for this graphic here. But let's consider them here, like this one, which is an affiliate or Amazon Kindle digital product. Deal size 1 million to 1.5 million. So that's about the range that they would expect to acquire this business in. And again, they're using the money to acquire businesses that are listed for sale, right? So they're not businesses that are already owned and operated. They're businesses that they're going to raise capital and you're going to invest in to acquire. So the deal for this one is likely to fall somewhere in the $1 to $1.5 million final price. That's still to be determined or to be negotiated. And the minimum investment amount is $20,000. So I think with WebStreet, the minimum investment amount is $20,000 or $30,000. I know this graphic here says $20,000, but I believe somewhere on the website I saw a minimum of $30,000. So I don't know, but it's somewhere in that range. And with that, you do need to be an accredited investor, meaning you have income of either $250,000 a year, or you have a net worth, I believe, excluding your primary house, of over $1 million. So this is not, a very small investment. I mean, it's small in the grand scheme of business acquisitions. And if you have $500,000 of capital to deploy, you can make a bunch of small investments. But when I say this is not for small investments, I mean, this is not something you just want to invest, or you can't just invest a few dollars a month in. You do need to put some serious capital into it. But again, you don't need to have all of your capital sunk into just one thing. You do have a basket here that you can diversify into and have fractional ownership of a bunch of different businesses, right? So in this case here, the examples, we got an Amazon Kindle digital product / affiliate business. We have an e-commerce drop shipping business, a digital advertising business, could also be a SaaS business. It could be a digital service business. Fundamentally though, they are all going to be online businesses. And I mean, let's just look at them here. The biggest one they have in the example is $20 to $22 million. That's a pretty big online business. Smallest one here being $1 million. I think in my own personal experience, the smallest one they would probably consider here is a $1 million business, because as businesses go up in size, they become more stable. Generally, there are exceptions to the rule. And I actually looked at a software business that was for sale that had an SDE, and in the business listing had an SDE of $500K, right? But once I looked at it, the SDE from 2 years ago or 3 years ago was like $3 million, and the most recent year was zero. So even though a sizable business, that was not very stable. But generally, as you go up in size, the businesses become more stable. There's more meat and potatoes, so to say, to work with. So I would expect the minimum deal size to be $1 million. maybe $20 million or larger is not unrealistic. And I don't know what the maximum amount is. The bottom line is, though, you do need to be an accredited investor and you are investing to acquire established and already profitable, usually. There may be some exceptions to that rule, but I believe WebStreet is going to be focusing on already profitable businesses. Quick interjection in editing here. One thing I'm unsure of, but I'm really curious about, is whether you get to see the name of the business before you make an investment in it. So, for example, do you get to see what actual affiliate in Amazon KDP business you are investing into so that you can do your own more in-depth due diligence on that business and if you actually want to make this investment or not? I'm not sure of the answer. I'd love to know. If you know, do let me know in the comments below. Now let's jump back to it. All right. Now let's talk about, who's operating these businesses, and we can see some details here with their portfolio managers. So WebStreet goes out and sources portfolio managers. Portfolio managers operate the business. They invest 5% into the fund that is acquiring the business. So they're a 5% owner. They do get 4 to 5x leverage. We'll talk about that in the fees. But the big thing here is the portfolio managers have skin in the game and they're vetted by WebStreet, or formerly Empire Flippers Capital. So WebStreet, I believe, is owned by Empire Flippers, the brokerage, and I would consider Empire Flippers, the brokerage that I've followed for several years, a very reputable brokerage. I know in the online business space, I run across some of them that have some kind of scammy, not scammy, but spammy style websites, like some crap businesses out there. Empire Flippers has done a very good job of, not taking those and avoiding those and only bringing quality to the table. And I like that about Empire Flippers. So I have a lot of respect for Empire Flippers from the get-go, and I believe that would carry over into their WebStreet platform. And point I was trying to make here, a whole lot of words to say, they go out and they find portfolio managers with experience running online businesses, and they invest 5% of their own money into the fund, so they have skin in the game. That is what I really like about them, and that is how WebStreet fundamentally works. Let's just see here if there's anything else I can pick out. The benefits for WebStreet, right? You get liquidity, and there's the investor pool, etc. Aligned incentives here. Payouts to portfolio managers and WebStreets are based on profits only, creating a win-win scenario. Portfolio manager salaries. No portfolio manager salaries or hidden fees in the funds. This is good. We'll talk about that, I think, when we get to the fees. Portfolio managers' performance will be public to determine access to future funds. Yeah, so that, I think, wraps it up here on how it actually works. You invest money to acquire an online business that is established and profitable. Your return comes in the form of, and I guess I haven't discussed this yet, your return comes in the form of profits distributed from the business, as you would expect, and also profits when the business sells. From what I can find, looking through this website here, they plan to hold the websites for 2 to 4 years before selling them. Now let's kind of shift gears here and talk about the economics of website investing. Right here, we can see WebStreet publishes return expectations of 20% projected average annual returns. Is that good? Is that bad? Is that realistic? Well, to get an idea, we have to have a solid understanding of how online businesses earn returns. And if you've had any investment experience with the stock market, you certainly know 20% average annual returns is very, very high. WebStreet provides us some further details here. When you click on it, I'm not going to read through it, but I'm going to kind of explain what you need to know out of my own head here from my own experience. And that is A, websites earn returns by generating profits and cash flow from their operating business activity, right? Like that could be software, that could be advertising and content, could be producing a digital service, could be selling physical products. Those are your most common ways that online businesses are going to earn profit, and ultimately the profit gets distributed. That is a form of return to you. And then they also earn returns when the businesses are sold, if they're sold, in appreciation of the asset value. All right. So, and sometimes profit and cash flow is needed to improve the asset value. Now, I went through WebStreet's website here, and what I could find was that they plan to hold the online businesses for 2 to 4 years. Of course, it's hard to know when you're actually going to sell the business, but it seems like 2 to 4 years in, they're going to probably be looking for an exit point, and that's probably going to come at about the point when they feel like, or the manager of the business feels like there's no further room that he can personally grow it. right? Because with businesses in general, you're getting a valuation multiple on the actual earnings. So if you grow the earnings, you're going to grow them, you're going to grow the total valuation price, even if the valuation multiple stays the same. But if the valuation multiple increases, as is common when businesses increase in size, in other words, let's just say a business that has $1 million in profit is going to get a 4x valuation, 4 times annual profit. If the business has $5 million in profit, it's probably going to get like a 5 or 6 times, maybe even more, right? So you get that appreciation in asset value. That is how these online businesses earn returns, and how you as a WebStreet investor or investor in a deal you source through WebStreet is going to get your returns. You're going to get the distributions of profits as they're allocated to you, and distributions of, appreciation or the value when the business is sold. Now, let's kind of talk about this in comparison to, say, investing in the stock market or something, right? And here's the thing. When you buy an online business, it's going to be at a valuation multiple that's generally going to be much lower than what it would be if you were investing in the stock market. And let's see if there's any valuation multiple details up here. No, we don't see any up here. But let's just say that you have a business that is producing $333,000 a year, and it's being sold at a 36x monthly multiple, so 36 times its average monthly profit, or 3 years we could express that as. In other words, it's getting sold at a 3x multiple. Well, publicly traded businesses like what are in the stock market, like the S&P 500, which is what VFINX is, are sold at a much higher valuation. I think that the valuation is a price to earnings ratio right now of about 17. And that is price to earnings. That is not actual free cash flow. So online businesses are valued on free cash flow, not accrual-based earnings, right? So with accrual-based earnings, there are ways that publicly traded businesses can show earnings without actually generating cash flow, right? And that might be selling a portion of their business for stock. Uber did this with a fragment of their business in Europe recently. They sold a part of their business in Europe. They sold the European Uber to another company who paid them in stock of their company, and they reported earnings, but really all they had was an illiquid stock at another European company. So it's a real, kind of fudging of the numbers, cooking the books, so to say, that often happens in public earnings, whereas these online businesses are valued based on cash flow. So if you were to look at the free cash flow yield of the S&P 500, it would probably be like 4% or something, maybe 3%. It's incredibly, incredibly low. And if you're comparing that to the free cash flow yield of your investment in an online business, well, then that's maybe going to be 30%, at the highest, probably 20% at the lowest. I would assume that it's a 5x multiple. So the free cash flow yield is much, much higher on online businesses. All right. And then there's, of course, the appreciation. It's hard to compare online business valuation appreciation with the stock market, but generally they do appreciate as the stock market is going up. So I think that is very important to consider here. What else should we talk about here when it comes to the economics of website investing? And I covered the profits, the appreciation, the valuation of online businesses and small business in general to the stock market. Yeah, I think that about winds it up here in the economics. What do I think about the 20% projected average annual returns? I think that this is pretty realistic, right? So for example, let's just say that the business is producing 33%, free cash flow as a yield per year, right? Let's just say the business is bought. Let's be more conservative and say it's bought at a 4x valuation. Well, then it's a 25%, return annually, and that's going to assume you sell the business at the same price. If you pay a 4x multiple, your free cash flow yield is therefore 25%. It stays the same. You own it for 3 years or however long you own it. It doesn't matter. You own it for a period of time. You sell it for the same price you paid for it. Well, then your average annual return is going to be that 25%. In this case, there's going to be some WebStreet fees, which we have not gotten to yet. I'm going to cover that next, I think. But by and large, you're going to be getting pretty close to it. And then there's going to be asset value. I would say that 20% is realistic. I would say it's certainly not conservative, but it's certainly not aggressive. 20% on the deals seems like a realistic, average annual return. And I did find some details here in their 2-year performance, because they have been around 2 years prior to WebStreet, their Empire Flippers Capital. And right here, despite a tumultuous economy, round one portfolios have delivered 15% cash distributions in the last 12 months and are on track for over 20% annualized returns over the lifetime of the asset. So clearly here they're planning for a little bit of the return to come in the form of asset value appreciation. Now, interestingly enough, there are a couple publicly traded companies that acquire online businesses. So I just wanted to pull them up, and you may have already seen them on my chart here. CNSWF is a very interesting and amazing company that acquires small vertical market software businesses. In 2022, they acquired over 100 vertical market software businesses, and the acquisition average price is only like $3 million, I think. It's very low, and mind you, their market cap is $40 billion. So they make their money by just acquiring a lot of these little vertical market software companies. Their stock performance has been incredible. IAC, Interactive Media Corp, went public in 2020, and, well, you can see it is it followed the COVID bubble and burst very well to a T there. I don't follow that company very much, but they don't really get into the software space. They stay in, they kind of more stay into like media brands and content websites. Very large ones, large brands. You wouldn't really think of them as a niche site, but that is what they do. So 2 of them here, and they've performed very differently. Personally, I love Constellation Software. I think it's a very interesting model, and their financial performance has been incredible. That said, here we got one boom, we got one burst. We don't know how the WebStreet portfolio will perform going forward. That is always the risk of investing. Now let's shift to talking about the risk, right? What is the risk of investing with WebStreet here? Of course, there's always fraud risk. I don't believe that will be a major issue here. I don't see that as a major issue. That is not something that really comes to mind, but it is something that you need to consider, okay, with these businesses. Empire Flippers and WebStreet are very transparent in it. And they're buying established businesses, and it's very clear what you're getting here. All right, so I don't think that there's a big risk of fraud. Now, then there's your inherent business risk. Those kinds of things could be, if it's a content business, Google updates their algorithm and the business goes to zero. SaaS, maybe the software gets, rendered obsolete. Digital services, maybe there's competition in the marketplace, right? Those types of things are very normal here. I will say there's the Lindy effect to consider, and that is the longer something has been around, it's just as likely to stay around and do the same going forward. So older businesses are something I tend to look for. If you watch any of my other videos on online business acquisitions or online business breakdowns, I always talk about the age of the business. I prefer older ones. So if I were looking into one of these deals here, I would want to know how old the business is. It'd be a very big factor, along with what it actually does. You have that risk. There's the Google update risk. For that reason, I personally don't like acquiring content websites unless they are a brand and a well-established brand. You have those risks when you invest here with WebStreet, and that's something that's going to exist in any small business investment that you make. Finally, let's talk about the fees, because fees can really eat into an otherwise great investment. WebStreet keeps it pretty simple. We can see the capital stack here, 95% investor capital, 5% portfolio manager capital. And then there's profit split and carried interest. Here's where things start coming out. 66.7% of profit goes to investors. Where does the other 33.3% go? Well, 20% of that goes to portfolio managers. So recall, portfolio managers are not paid a salary. Instead, they're paid a percentage of profit, which is good because, that aligns their incentives. In other words, they have an incentive to grow their business, because the more profit it makes, the more they ultimately make. They're getting 20% of it. Then 10% to WebStreet, the house always gets their cut, and 3.3% to advisors. That one kind of struck me as, I don't want to say odd, but just something I don't really like, right? Like, who are the advisors? I'm going to take a guess here and say that they're probably either the founders or owners of Empire Flippers currently, right? So it's kind of like adding another fee to the house in the actual stack of things and what's getting cut out. That said, the fees are not terrible. I would not consider these egregious. I have seen real estate funds with far worse, far worse fee structures than that. All right. These things are taken out of profit. This is very important to point out. These are taken out of profit. A lot of times when you look at real estate investment funds, they take it right out of top line revenue. That is not the case here. So, admittedly, as an investor, I don't like fees, but fees are the price you have to pay for passive investments in certain asset classes here. And I do not think these are egregious. Now, one thing that I was wondering is how exactly the sale of the business works, right? Like when it gets sold, how does that capital get distributed, right? So I went in here and I took a look at things and I found in the FAQ, investors, how do exits work on this question here? Investors receive 2/3 profit on any increase in sales price, and investors will receive their final distribution at that time. So I like this. This does mean that investors are likely to, I don't want to say going to get their, I was going to say they're going to get their investment back, but obviously the business could sell at a loss. But if an investment is sold at a gain, or if the asset is sold at a gain, the online business is sold at a gain, the investor gets their investment back, and then whatever the profit is, so if it's a $2 million site sale that they acquired for $1 million, therefore they have $1 million in profit, 2/3 of that goes back to the investors, and then 1/3 goes to the portfolio manager, the website operator in this case. One thing you have to consider is that from all my examples in the economics of websites investing, you do have to take a haircut out of that, which I think is reflected in the details that you see here. It does kind of make sense in that. You have to take a haircut out of it. I really don't like the so much, take of the actual business sale going back to the ultimate WebStreet and advisors and portfolio managers. I think it seems a little high there, but again, you have to consider that incentivizes them to grow the investment. So again, fees are not egregious. I would say they're in the realm of fair for what's going on. As you can tell from the tone of my voice, I do not like any fees here, but that said, I don't see these as being anything egregious like what you often see in real estate funds. On that note, let's wind it down with my take on WebStreet. I personally really like what WebStreet brings to the table here, and that is the opportunity to passively invest in online business acquisitions. I mean, I've had a lot of experience in the online business space. I know that these businesses can be very robust and very lucrative. And what I really like about it, as opposed to the stock market, is you get to invest in businesses that are producing higher cash flow at a relative lower price, right? Remember what I was talking about, the free cash flow yield of the S&P 500 versus the free cash flow yield of online businesses. And also, online businesses can grow quite rapidly in the right hands. Now, of course, WebStreet is too young to really tell if their portfolio managers have the experience to grow these businesses rapidly or if they're just going to stay the same. But by and large, if the businesses don't grow, right, and let's just say that economic conditions remain stable and the businesses don't grow, you're still getting a great return on your investment. So personally, I like WebStreet here. It's something that I am considering investing in to get more exposure to online businesses as an asset class. So if you guys have any questions about WebStreet, or if there's anything you feel like I missed out on, let me know in the comments below, guys. And hey, if you found this video helpful and insightful, be sure to do me a sweet one. You know the drill. Smash that like button and do yourself a sweet one. Hit the subscribe button so you get all of my latest insight into online businesses. I'm calling it a wrap and signing off.